All right, good evening, everyone, and welcome to our second webinar with Ethical Finance. Tonight, we're going to be going over the DeFi basics, and then we'll be reviewing the Ethical Finance token business model. So first part of the session, I'm going to be taking you through some of the DeFi and on-chain fundamentals, just so that you can get the basic understanding. And then in part two, we're going to be bringing in the CEO and founder of Shoeb, who will be taking you through the ethical finance token holder business model. So that will be part two of tonight's webinar. Quick little disclaimer, all of the content that we produce for you is for educational purposes only. It's not financial advice. We always recommend that you do your own research. Actually, next week's webinar, we'll be diving deeper into how do you do your own research, what tools are available for you. And also, this content is always recorded and we actually share the recording. So if you can't stay for the whole webinar tonight, then you can catch up on what you've missed because we'll share it inside the Education Hub. For those of you that haven't had a chance to meet me or attend one of our previous webinars, my name is Danielle Marie. I am the co-founder of Evolver and All Things Blockchain. I won't go too much into those, but they're both social impact projects where we host educational networking events globally. And I've been a crypto and blockchain educator for over 5 years. So we do have some upcoming webinars. If this is your first time tuning in, we're hosting these every single Wednesday. So as I mentioned, next week we'll be talking about how to do your own research and what's dollar cost averaging. And then we've got a few more coming up. So if you haven't already registered, I highly recommend that you join the Luma page because that's where we list all of our upcoming webinars. I mentioned the Education Hub. If you already haven't signed up, this is where we share all of the recordings. And then we also already have some on-demand short courses in there. And we're currently working on building out some more short courses in there with our education sponsors, Digital Surge, Stand with Crypto, Nexa, and Ethical Finance. So that is your kind of one-stop shop. It's 100% free. So please make sure that you've signed up and share that with your friends. We recently launched a community hub on WhatsApp to try to give a space for people to be able to connect with other people. We also share, upcoming events. And our goal is to kind of create this into your kind of go-to place to connect with others and stay up to date with information within the ecosystem and also between Evolver and All Things Blockchain. So let's dive into it. Part one. Welcome everyone to part one of your educational session where we're going to be talking about the basics of DeFi and on-chain fundamentals. It's really important that you understand the basics. We're not going to go into a deep dive because it is quite a complex topic, but today should kind of give you a little bit of an overview of the basics that you need to understand to participate in the DeFi ecosystem. So what is DeFi? So it stands for decentralized finance. Just out of curiosity, all the people that are on the live call, has anybody ever participated in the DeFi? You can just put a yes or a no in the chat, just so I can kind of get a sense for who's in the room. But DeFi is where financial services are built on blockchain networks. They operate something called via smart contracts. Now, we're not going to dive deep into smart contracts. If you're not familiar with what those are, I recommend that you take notes as we go through today's session. You will have an opportunity to ask questions. You can also ask in the Education Hub or inside the Community Hub, but please go and do a little bit more research on smart contracts, but they're basically the backbone of DeFi. There's no central bank or intermediaries required. And it is essentially a peer-to-peer value exchange. It's completely transparent, programmable, and global. And that will kind of make a little bit more sense as we kind of go through today's lesson. So let's explore and look DeFi compared to TradFi. I'm sure a lot of you are familiar with TradFi, but DeFi may be quite new to you. So let's kind of do a little bit of a comparison. So TradFi, traditional finance, it's controlled by a central authority. So this may be a bank or, different types of funds. And the transactions often can take days to settle. Now, it really kind of depends. Locally, you might not notice it. So, I'm based in Australia. If I send somebody money in Australia, we have things like Pay ID. It can get there quite quickly. But a lot of the times, if you're sending money globally, it can often take many days to settle. So it's a little bit slow. There's also limited operating hours. So, for example, if you're trading any type of stocks or commodities, you're restricted to when the markets are open. Cross-border friction and transaction fees. So this kind of goes back to where it takes days for the transactions to settle, but also a lot of the times there's very expensive fees because there's a lot of intermediaries involved. So I'm sure some of you have, tried to transfer money overseas before, and you generally, get stung in a few different ways. You get the exchange rate, maybe what your bank is giving, then you have to pay fees. It often can take days, as I mentioned, to settle. So it's really not the most efficient way. And then, more importantly, if you want to borrow money, if any of you have ever tried to get a loan from a bank, whether it's a small loan or you want to get a mortgage, you have to get approval. And it's usually quite a lengthy process. It's quite invasive. They ask you lots of questions. And a lot of the ethical finance business model, which, if any of you attended the first session that we had, it is essentially being built to help people that can't get loans for a home loan because traditional finance, authorities or institutions won't provide them loans. I'm a prime example of it. I've never missed a rent payment my entire life, but because I'm self-employed and I don't have, a lot of assets, I can't get a loan, for example, for a home loan. So now let's compare that to decentralized finance. As I mentioned earlier, it all operates through smart contracts. What does that mean? It's basically done by code, and these transactions are settled in minutes, sometimes even seconds, depending on what chain you're using. We're not going to dive too deep onto the different types of blockchain. There's other courses for that. But if you're settling it on a very fast blockchain, it could be seconds. If you're doing large transactions, say for example on the Bitcoin network, it may take several minutes for those transactions to be confirmed and then validated on chain. The other thing is DeFi runs 24/7. The markets don't close compared to the traditional finance, so you're always able to trade. You don't have to wait till Monday morning to put on your trades. It's absolutely borderless. Anybody can participate. You don't have to do any types of KYC. I previously, a couple webinars ago, we talked about the difference between centralized and decentralized exchanges. If you missed that webinar, go ahead and watch that to understand the differences. But there is no KYC. And borrowing is based off collateral. We'll unpack that a little bit further on into the lesson. But as long as you have, let's just say you have one Bitcoin, then you can put that Bitcoin up for collateral and get a loan. There is no approval process such as you would have to get if you went to an institution or a bank. So what does on-chain actually mean? So it essentially just means that all of the data, the transactions are recorded on the blockchain. If you are watching this webinar and you're not really sure what blockchain is, you've got to go back, go to the Web3 basics. There's some lessons in there that can teach you about what blockchain is. We're not going to unpack that in today's lesson. But it's public and it's verifiable ledger. That means that all of the transactions are 100% transparent and on chain. So once the transactions are verified and then put onto the blockchain, they can never be altered or tampered with, and anybody can see the transactions on the blockchain. So as I just mentioned, they're immutable once they're confirmed. So that's why when we are waiting for transactions to be confirmed on the blockchain, once they're added on there, that essentially means that they can never be tampered or altered with. Now, it's executed by code. So, as I mentioned earlier, smart contracts, all smart contracts are basically putting the terms of the conditions in by code. And when those terms and conditions are met, then the smart contracts basically executes the transactions. And as I mentioned, everything is completely transparent and you can see the history of any type of wallet address. You could go in there. If somebody sent you a wallet address, you'd be able to go onto the blockchain, say, for example, like the ETH Explorer or the Bitcoin Explorer. You'd be able to put in that wallet address and you would be able to see every single transaction that has ever been made. And we don't have that transparency through traditional finance. So when you send money, through a bank, you only get to see, okay, the money has been sent, and then maybe when the money arrives, we don't actually have any transparency. I think I'm back online. It cut off for a minute. We don't actually have any transparency of the history of the transactions. So on-chain means that it's recorded, verified, and executed onto the blockchain. What are decentralized exchanges? So I went a little bit deeper in this a couple of weeks ago, but let's just cover it high level. So it's a platform for peer-to-peer token trading, which means that there is no centralized exchange, there is no KYC, there is no customer service, there's no central body that is basically controlling the exchange. It uses something called liquidity pools. We're going to cover that in a couple of slides. Price is determined algorithmically, and it is essentially the backbone of DeFi. So some popular DEXs, which is the short term for it, is Uniswap, PancakeSwap, and Radium. But if you're new, I really don't new to the ecosystem. I really don't recommend that you start playing with decentralized exchanges because there is a lot of risk involved in understanding, especially the liquidity. So a lot of the times when a token is put onto a centralized exchange, the exchange is providing the liquidity, and that will make a little bit more sense in a couple of slides when we get to that. So you just have to be very, very careful if you are going to be participating in using decentralized exchanges and say buying tokens that you can't get through a centralized exchange. I will say a lot of the times if there's a new token, say somebody or a friend tells you, hey, there's this really cool project and you should buy this token. Actually, somebody sent us a message the other day asking about some tokens and where they could buy them. We recommended that they go to CoinMarketCap to see what exchanges listed them. But a lot of the times, if it's a new token and it's not listed on a centralized exchange yet, a lot of the times your only option is to buy it on a decentralized exchange. And the thing that you need to be really looking at is how much liquidity is there, because that's how risky it is when you are, say, buying a token off of a decentralized exchange. So liquidity makes essentially means how easy it is to be able to buy or sell something. So if there's not a lot of liquidity, if there's high liquidity, it makes it really easy to buy and sell. And it also makes it so that you can trade easily without having a huge impact to the price. Low liquidity will mean that the price moves quickly when people buy or sell. So it's important to understand the liquidity. So you can kind of think of it like money available that's in a pool, and the more of it, the smoother the markets. So it really is important if you're going to start playing in the DeFi world that you learn how to research a token, what platforms is it on, how much liquidity. these different types of tokens, they have to think about what dexes they are going to be available on, because the more dexes that they're on, that means the more liquidity that they need to provide. So a lot of the times they'll just pick, one or two, and they have to, in the beginning, provide liquidity until people are actually organically buying and selling these tokens. So, how does liquidity work in DeFi? So, users deposit tokens into liquidity pools. So, this is an opportunity for people in Web3 that are looking for ways that they can make money in Web3, but also in saying that you have to really understand it. But if you deposit tokens and provide liquidity, you can actually earn rewards for it. So all of the trading is based off of the liquidity that is powered by the token providers. And then obviously go in and they can buy and sell based off of the liquidity pools that have been provided. This activity generates fees. So every time somebody trades, it doesn't matter if it's on a centralized exchange or on a decentralized exchange, there's always going to be transaction fees. Same with banking, there's always going to be fees. So I always explain to people that DeFi is no different than the traditional financial ecosystem. It's just that we're using blockchain payment rails and it's faster and cheaper compared to traditional finance. But there's always going to be fees. So you do want to be taking a look at that. But the liquidity providers, so for example, if you were to provide liquidity, what happens is that liquidity gets locked up into like a smart contract. And I'm not going to go too deep into that. I am not a DeFi expert, but from my understanding, depending on the terms of the token that you're providing liquidity for, it could be set to daily, monthly, yearly, and then you would get a portion of the fees. So let's just say you provide $1,000 of Ethereum to a liquidity pool, and then every time there's transactions of buying and selling, you would get a small portion of those transaction fees. And that's how people can earn tokens by providing liquidity to a liquidity pool. So here is an example. I think this was Uniswap that I went on to, and you can see on the left a very low liquidity. So TVL means total value locked. So that is the amount of tokens and the liquidity of the tokens that are locked into the smart contracts. Compared to on the right, the TVL is 10.2 million. So clearly, the token on the right, which is Bitcoin B and BNB. I just picked random tokens, by the way. So definitely not recommending that you buy or sell any of these. I just did it as to kind of give you a visual that if you are going to participate in the DeFi ecosystem, you really want to go and see how much liquidity is provided. Because the more liquidity, the basically kind of the less riskier it is to participate in buying and selling those tokens. So, for example, on the left-hand side, if somebody went in and sold a huge amount of tokens, that could dump the price. If you've ever heard of like a pump and dump, that is often what happens. Projects will pump up the token, they'll provide lots of liquidity, they'll market it, and then some of the main token holders will go in and they'll sell all of the tokens and the price will drop. Now, a lot of projects these days have implemented vesting schedules. So, for example, the early stage investors, because back in the day, when projects would have their TGE, which stands for Token Generation Event, the early investors would get their tokens and then they would go, onto a DeFi exchange and they would sell their tokens and the price of the project would drop. So now a lot of the times these projects will implement these vesting schedules to try to avoid that from happening. So we'll cover a little bit more of this when you're doing your own research, but it's very important to understand tokenomics and understand the vesting schedule of when the tokens are going to be released, and how much is in circulation to really kind of understand the health of the token in terms of the longevity of the token. So that's probably about as deep as I'm going to go into liquidity. But next, we're going to talk about on-chain lending. So I talked about that a little bit earlier. So what is on-chain lending? So once again, it's all done through smart contracts. And there's no bank in the middle. As I mentioned, there's nobody that is going to go and look at, how much money you earn and have you paid your bills and what your credit score is. There's none of that. All that they care about is if you have collateral. Now, the reason why this is very risky, there's lots of different platforms. I have a friend of mine that has made a lot of money doing this, and he's been telling me for ages. I think he uses a platform called Nexo, that you basically go in and you put your Bitcoin up for collateral. And then what he does is he actually gets the loan, and I think it will vary from different platform. For those of you that are based in Australia, there's a platform called Vield. They also do this on-chain lending, but you basically provide your collateral. We'll just use Bitcoin as the example. So let's say you have one Bitcoin. I think they give you like 50% of your, and don't quote me on that because I don't play in this space because I just find it a little bit too high risk for me. And you have to be watching the markets all the time because they'll give you, so if we just use simple examples, say you put in one Bitcoin, they'll give you a loan, the equivalent of half bit, zero point 0.5 of a Bitcoin. And then there is a point where you could get liquidated. And that means that if the price of Bitcoin drops to a certain point, then you lose your collateral. So this is why it is high risk. So you have to be very, very careful and you have to make sure that you're watching it. Now, my friend who is telling me about this on-chain lending, of course, you can have different notifications. You can watch it, but let's say the price of Bitcoin drops by like 30% and it's getting close to your margin call. You do have the option of depositing more collateral so that you don't lose your collateral that you have put in. But it's very, very important that you keep an eye on the prices. You know what your liquidity margins are. So this is why I recommend that you don't play in this space unless you've done your homework and you understand all of the different types of risks. But you do not need to get permission. All you need is collateral, and they're all automated by code. So there's nobody, it will have the terms and the conditions in there, and once it hits that amount, you'll be liquidated. So it's quite important that you understand what the rules are, and what the risks are before you start playing in this space. But my friend that I was telling you about, he would go and put his Bitcoin up for collateral. He would get a loan in stable coins. Then he would take those stable coins and then he would buy more Bitcoin. And then when the price of Bitcoin would go up, he would sell that Bitcoin and then then put that Bitcoin in to the pool, so he'd have more collateral. So then that would mean that he would have more wiggle room for the margin. So on-chain lending replaces the loan approval with collateral and code. So nobody needs to approve it, but you also have to have the collateral to be able to get the loans. So how is yield generated? So this is something that I've always kind of wondered in different projects. You'll hear of different projects that are offering like crazy high yield. And for a while when DeFi very first came out, there was projects that were paying crazy, like, 20, 30% yield. And I always kind of wondered, how is that yield generated? Now, it will vary from project to project. So this is why it's very important for you to understand how the yield is generated. But ultimately, if we're looking at it from the lens of people that are getting a loan, so if you are providing liquidity to to people that are taking out the loan, the borrowers pay interest. So the people that are providing the liquidity to the people that are borrowing, then they basically earn that interest that the borrowers are paying. So it's very same to if you were to go to the bank and you were to get a loan, they would say, okay, well, you're going to pay five. I don't know what the average loan prices are at the moment, but let's just say between 5 to 10%. Credit cards are crazy high. I think they're like 19 to 20%. It's the same, but the interest rate in the DeFi spaces are tend to be quite low. Also, the traders, as we talked about earlier, when people are buying and selling, there's transaction fees. Some protocols also offer incentives. I can't remember the name of the project, but I was listening to this podcast, and it was this new protocol that had come out, and they had incentives for people that got in early, and they were providing really high yield, but it was only to a max of like say 250 million, and once it hit that, then the yield would drop. So that will kind of vary depending on different protocols, and a lot of the times they do that in the beginning. So it's kind of if you get in early, you have an opportunity to make more yield, and they do that to try to obviously incentivize people to participate. So when you think about yield, it really comes down to the economic activity of the project or the token, if you want to, whatever terms that you want to use. So if activity is slow, then the yield can decrease. So it's really important to understand when you're looking at a token, you're looking at maybe participating, if you're thinking about providing liquidity, or if you are thinking about taking a loan, you need to really understand the tokenomics, understand the economic activity. It's not guaranteed. It's the same as the banks. Depending, obviously, banks, have fixed rates and variable rates, and we're not going to, go into that on a deep level because I'm not an expert in it either. But I just want to really highlight if you get involved in a project and they're, say, offering like 20% yield, doesn't necessarily mean that they're going to be offering 20% yield forever. It really kind of will depend on the current economic activity. So it's really important that you take your time to understand that before you get involved. So what is staking? Just out of curiosity, anybody that's on the call, has anybody here staked any tokens before? Just put a yes or a no in the chat. Okay, we've got some yeses. What tokens have you staked? Very cool. All right. So, for those of you that don't know what staking is, so we talked about before how you can provide liquidity, say in DeFi. You can also stake depending on some centralized exchanges offer this. There are some DeFi protocols that offer this. It really kind of will depend, but it's essentially where you lock up your tokens. So remember when I talked about TVL? So that's the total value locked. And that is basically saying that there's this amount of tokens locked up in a smart contract. So the higher the TVL, the more secure that network is, that token is. So you basically will lock your tokens for a certain period of time. Now, this will vary depending on different projects. So to give you an example, Ethereum, when Ethereum came out with their staking in the beginning, before it moved from proof of work to proof of stake. And if you don't know what that means, not a worries. We're actually going to be covering that in the next webinar with Nexa. But you had to lock up your tokens. I think it was for like 2 years. I have, staked tokens on the Polkadot network and a parachain before. I had to lock, this was many years ago. I had to lock them up for 2 years. It's a very long time. Sometimes protocols, it might be 24 hours, it might be months. So it's very important that you understand how long, if you are going to provide tokens to a liquidity pool and lock them up and earn tokens for providing that liquidity, you want to know how long your tokens need to be locked up for. And you also want to understand what rewards you're going to get in return. And then also how often are those rewards earned for you providing the liquidity to the network. So they are paid via the network. And once again, this is all done in smart contracts. So before you dive in and start, any type of staking, you really want to understand the terms and the conditions. Now, a lot of centralized exchanges do offer staking services. So this is where they will be staking it on your behalf. Um, compared to sometimes you can stake via your cold storage wallet, so your Ledger or say like your MetaMask wallet. There are also platforms that provide just pure staking services. I think Rocket Pool, for example, is one of them. So there's lots of options, but just make sure that you understand if you are staking on a centralized platform, you are essentially giving them your token. So you're giving them and you're trusting them to stake it on your behalf. If you were to go and say stake Ethereum, or any other type of token that uses a proof of stake mechanism, and you were to do it yourself, then you would need to, learn and understand how you connect your wallet and, you do all of the logistics in and behind it. So a lot of people like to use a centralized platform because they don't have to think about all of that, and then they can just trust the centralized exchange. But at the same time, you are trusting them to basically hold and custodial your tokens for you. How does staking secure the network? So we're going to dive a little bit deeper in this in a future lesson, but I thought I would go over it very high level. But your tokens are delegated to a validator. So validators are what secure the proof of stake network, and we'll dive a little bit deeper in a future webinar, the one that we're going to do with Nexa on April 8th. But these validators are the ones that confirm and add new transactions to the network. Depending on the network, so for example, with Ethereum, in order to be a validator, you have to stake 32 Ethereum. So whatever the price of Ethereum is right now, I think it's like 4,000. So 32 times 4, that's quite a bit of money that you have to put to secure the network. And this is essentially their security deposit. And if they are bad actors, if they're dishonest in any way, they could lose a part of their stake. And so this really tries to keep the network secure because they are at risk if they're trying to be a bad actor and do anything wrong, that they'll lose their stake. So if you aren't a validator, people that are staking, so maybe you don't have 32 ETH, but you have one ETH and you want to, provide that to a staking pool so that you can earn yield on it because it's just say sitting in your wallet, then essentially in a smart contract, that one Ethereum is delegated to a validator who basically validates the transactions on your behalf. It's much more complex than that, but just on a high level, that is how staking secures the network. So let's just do a brief overview of staking versus lending. Okay, so staking is when we provide tokens to a liquidity pool. It helps secure the blockchain. You can earn rewards and it secures the network. Lending is when you're providing capital to borrowers and you're earning interest off of them and you're supporting borrowing activity. So both of them are an opportunity for you to make money, aka tokens, in DeFi, but they're both doing different types of economical activity. One, you're just staking your tokens, securing the network, and the other one, you're essentially loaning money to people, and then you're getting the fees that they're paying. So, what are some common risks in DeFi? Smart contract risk. So, this is where smart contract audits come into play and are very, very important. Hashlock are one of our sponsors for all things blockchain. They're one of the largest Web3 security auditing firms in Australia and globally. And so, you really want to know if you're investing in a project if they've had their smart contracts audited because the developers are the ones that are coding these smart contracts. And if there is dodgy code or if there's backdoor or if there's errors in the code, then because essentially all of the money is kind of going into this pool that is kind of protected by the code of the smart contract. So it is important to ask or go and do some research if you're going to invest money in staking or lending. Have they had their smart contracts audited? Do they share that information? Do they have a smart contract audit available for you on their websites? Maybe they might not have it available on their website, but maybe you go and you ask somebody in their community. If they don't have a smart contract audit, I personally wouldn't touch it. Market volatility, I'm sure as many of you are aware, what we would call is that we're in the middle of a bear market. So the market kind of goes up and down. So it really can kind of affect when you're playing in the DeFi space. As I mentioned, say if you're providing liquidity or you're say taking a loan and you're providing that as collateral and the market has a massive pullback. For example, Bitcoin is very well known for doing 20 to 30% pullbacks, sometimes within 24 hours. So it is very much a risk. Liquidity risk, as I mentioned earlier, depending on how much liquidity is provided, if there's low liquidity and say one of the main token holders goes and decides to sell all of their tokens, that can tank the price. Protocol and governance changes. We'll talk about this a little bit more, and I have covered this a little bit in the Web3 Basics course, but protocols and governance changes happen through different things like forks, hard forks. It's essentially when the community votes on making proposals or changes. And so you have to stay up to date. If you are investing in a protocol, you really want to be staying up to date with any types of changes. You want to be participating, you want to be voting, because any changes that are made within the protocol that could impact you, such as, a common one, say with Ethereum, they've been kind of talking and over the years about the different types of fees and burn mechanisms, and all of this comes down to the governance protocols, and people can participate in those decision making. And then regulatory uncertainty. So as I mentioned, DeFi, there is no centralized, authority. It's completely decentralized. And so a lot of people want to be careful because there is no, if you invest your money and they do a rug pull and they steal all of your tokens. There is no, a central authority that you can go to file a complaint to get your money back. So you really want to kind of pay attention. There is a lot of regulation coming in, around blockchain and crypto and DeFi, but it's still a big gray area at the moment. So part one, we're going to recap. I'm just looking to see if Shoeb has joined us yet. Doesn't look like he has joined the call, but let's recap. DeFi foundations. So DeFi replaces the intermediaries with smart contracts. So you're essentially removing the middleman and we're using code, these smart contracts, which is why it's really, really important to make sure the protocols that you're interacting with have had their smart contracts audited. On-chain activity, it's all transparent and automated, and it's all available for anybody to see. Liquidity depth affects the price stability. So you really want to understand if you are going to play in the DeFi space, what is the liquidity, how much tokens are locked up. Also, as I talked about earlier, you want to understand their tokenomics. How long are those tokens locked up for? So, a lot of the times when projects raise, through their seed or their pre-seeds, depending on how they've raised, they'll issue a certain amount of tokens to the investors. And we want to know how long those tokens are locked up for. And then also, what is the vesting schedule? Because that will definitely affect the price. And you also want to understand how many are in circulation. And all of these factors really play into the long-term, um, uh, what's the word I'm looking for? Stability. Sorry, the long-term stability of the token. So remember, yield comes from economical activity. So it's important to understand, go in and take a look. How much liquidity is being provided? How often are people? Is it a popular token that is being traded? Remember that slide that I showed earlier compared to that, two which had one had low liquidity, one had high liquidity. You can go in and see how often people are trading that token. And so all DeFi systems carry risk. So I always mention to my beginners, be very, very careful when playing in the DeFi space. I know a lot of people that make a lot of money in the DeFi space. Next week, I will be talking about the different types of traders. I'm a hodler. I dollar cost average. I don't really play in the DeFi space. I have staked and, I have bought tokens previously, off of Uniswap and stuff like that. And I do it a lot of the times because I like to learn. I think that you can learn by doing. But I am not active enough. We use a term called degens. I'm not sure if anybody would call themselves a degen here on the call, but it's a term basically to say like I know people that's their full time. All they do is buy and sell and trade tokens and offer liquidity, and so there is an opportunity to make money. But it's not one of those things like how I just dollar cost average, I buy my Bitcoin, I buy my Ethereum, and I don't really think about it. And it's because I'm a long-term believer. I'm a hodler. I believe in the tokens long term. So I don't have to continuously watch. When Bitcoin drops in price, I'm not stressed out because I don't have a loan against my Bitcoin. So I'm not risking of losing my Bitcoin. So it's really important for you to understand the type of trader you are, the amount of time that you have before you start playing in the DeFi space. So, questions and answers. If you have any questions, you can go ahead and pop them into the chat. Just waiting for our guest speaker, Shoeb, to join. So hopefully he'll be joining the call in any moment. But if you have any questions, you can go ahead and pop them into the chat. We've got some time there. Hopefully he'll be popping on in any moment before we jump into part 2 of the webinar. Otherwise, if nobody has any questions, I'd love to see what DeFi exchanges has anybody used previously. You can just put it in the chat. Binance. So you've used Binance's decentralized exchange because they have a centralized exchange and then they also, I think, have a decentralized exchange. I've never used Binance's decentralized exchange before. But that's actually a really good point. A lot of these big exchanges, so BitGet, Bybit, Binance, MXC, I think Kraken, I'm not sure. A lot of them will have their centralized exchange. This is where you can do on-ramping and off-ramping with fiat, and you have to have KYC. But then a lot of the times they'll have like a decentralized exchange where you can download their own wallet and you can participate in their decentralized exchange. Pancake Swap, that used to be a really big popular one. And I'm sure it still is, but I remember, when it very first came out, There was Sushi Swap and Pancake Swap. A lot of them were named after foods. I don't know why. But that one is actually built on BNB, and BNB is the Binance chain. So it offers low fees. So that's another thing, the differences between the different decentralized exchanges. It will be the different chains that they're built on. So Uniswap is built on Ethereum. Pancake Swap is built on BNB, which is the Binance chain. Binance chain is actually a layer two, which is built on top of Ethereum. Um, Solana Radium, that is that they have a few different types of decentralized exchanges. So yeah, important to understand what chains are the exchanges, decentralized exchanges built on that you are buying. All right. Welcome everyone to part two of Ethical Finance's token holder business model. I'm going to pass it over to Shoeb and he's going to take you through it. So I'm going to stop sharing and then you can go ahead and share your screen and take it away.
Okay, fantastic. All right, so let me do a share screen here. And I think it's this one. Click on share. Give me 1 second. I don't know why this is not. Let me click. Okay. All right. We all see this screen.
We can, it's just not in presentation mode.
Okay, how about now?
Yep.
Presentation mode?
Yep. But we can see the next slide.
Okay, that probably means that. Let me ensure this. Here. How's
There
that?
you go. Perfect. You're on.
Perfect. Okay, finally we got there. All right. Well, thank you for joining us this morning. I'm going to try and run through some basic information about our token model. And is this advancing? There we go. Okay. So basically, I just want to cover the very, essential elements of our token. And I'm hoping that, this is going to be appropriate for, token holders, people that are capital allocators, and hopefully there's, some sophisticated investors out there that'll really, understand the concept and what the potential is. So really, first of all, what is the ethical token? And the ethical token is a token that essentially funds property acquisition and allows for individuals that normally wouldn't qualify for traditional finance to be able to get into home ownership in a lease to own model. The ethic token holders, excuse me, have basically governance rights through the app, the Jara DAO app. Um, you're able to create proposals, vote on proposals, approve tenants, approve distribution of funds from the treasury for property acquisition. And the key element for the structure that we have, and I'll go into a little bit more on staking, but one of the key elements is that here in the US, in order to not be considered a security, you have to be able to pass the Howey test. And the main piece of that, I guess you would call it, is that you cannot have an expectation of return. So with the ethical token, you can vote on the project. You have governance, voting participation, but there's no expectation of return. So how do we handle being able to get a return? Well, first of all, there's the ability to stake. And the only way to stake is to convert one for one your Ethi tokens for Z Ethi tokens. The Z Ethi tokens can be staked and can earn rewards because they're not purchased, right? You're not a direct investor in Z Ethi. If you want to convert back, then again, it's a one-to-one conversion. Does that make sense to everybody? Hopefully. So with the Ethi token, in order to remain DeFi, decentralized finance, which is what is going to be basically required in order to be able to, um, fund rent-to-own transactions as a rental transaction and not a uh, a security transaction, if you will. So why do we want to use a token model? Well, again, we want to remain decentralized, right? And I'm going to actually come back to some of these other items and talk about decentralized common sense for a second. When you're in this finance space, and I've been in the finance space for a very, very long time. Um, our organization, our nonprofit started actually 21 years ago. And this concept of decentralized common sense comes from a scenario where uh, qualified tenants, people that as a landlord you would accept with open arms, um, because the risk is very little. They pay their rent on time, they've got good down payment, they've got good credit. Um, and even if their credit is slightly blemished, it doesn't matter. They have a good rental payment history. Uh, may be disqualified from being able to ever own a home. In many areas, the U.S. in particular, it's possible to own a home as an investment with zero income documentation. But if you want to own that same home to live in it, I mean, good luck getting qualified. So we want to put common sense back into the world of finance, particularly home ownership. This is our primary goal. Our belief is that if you can afford to make a rent payment, you should be able to afford to get into home ownership. And I can't tell you, what all the benefits of, home ownership are. I think you all know that it really builds a path to generational wealth, right? So that's our first concept is we want to use a token model because we want to be able to make rational decisions. We don't want to be in a position to, to approve or disapprove anybody, right? We want the community to be able to vote on whether or not someone should be approved or not, right? So in our application model, you qualify for 6 different programs. If you don't qualify for those 6 standard programs, you fall into the seventh category. That seventh category is a governance vote. And we would create a proposal. People would go on the app and vote on whether or not the individual tenant is worth taking a risk. And if the governance vote passes, we would close on the property within 3 days and enter into a lease to own arrangement with the prospective tenant. If the community decides no, this person is not worth the risk, then they're obviously not going to be a qualified tenant. Okay. But there could be mitigating factors, such as maybe they're getting government support for their rent. And this program, this lease to own program, generally, and of course, the programs are different all over, but generally qualifies for government rental support. And here we're starting our project here in the US. So it qualifies for Section 8. So people that are receiving Section 8 assistance in which their rents are paid, majority, by the government, is, pretty safe investment. So these are things that a governance vote, could take into account. But we don't make that decision. The community makes that decision. Okay. And so by having the ability to make these decentralized decisions, we need a way to be able to raise capital, right? Because we're not going to be able to raise it from traditional regulated sources. So we go into the um, uh, uh, crypto market, right? Essentially a decentralized market where individuals can provide capital. The capital is distributed based upon a governance vote, right? And it gives the token holders access to um, what we believe is a secure investment. Currently, again, we're starting in the US. We want to be able to ultimately expand into other stable real estate markets, but it gives the token holder the ability to participate in a project that is backed by physical real estate, right? There's a lot of projects out there which amazingly raise all kinds of capital and then somehow disappear, right? But this is backed by actual physical real estate, right? There's actually physically something there. So we believe that this is a much more stable project. Our organization has 21 years of history. Actually, March 6th was our 21st anniversary. So you're dealing with an organization that's been around for a long time. We're working in a market that's already established, a decentralized crypto market. All of the funds are released by a treasury vote, and we're trying to put common sense back into the world of finance. So capital flow, basically 51% of the tokens are held for liquidity. 49% are allocated to the treasury wallet. Okay, now when a lot of people, look at, our project, they see this distribution where one token is holding a majority of the the asset. I mean, I'm sorry, one wallet is holding a majority of the tokens. They say, "Oh, be careful, this could be a rug pull." Well, look, if you understand the project, you know that it's real estate backed. And anybody that's dealing in real estate understands that it's capital intensive, right? You need a lot of capital. And the only way for us to be able to do this, unless somebody has a better idea, the only way to really do this is to be able to reserve tokens for release into the market so that we can raise the capital that we need to be able to acquire assets and be able to rent them out on a lease to own basis. This release of tokens is not up to us, it's up to the community. So every single one of you out there that holds a token has a vote. If you think it's a good idea to acquire a property and release the tokens required to do that, then those tokens will get released. If you don't think it's a good idea, then those tokens won't get released. But the release of those tokens is not our decision to make. But because, once again, because real estate is a capital intensive endeavor, you need to have a high level of tokens available for the future growth and acquisition. And this is why when you look at the token distribution, you can go to, for example, Polygon Scan, and you look at the top holders. Well, the top holder is the Treasury bond. Oh, I went the wrong way. Okay, so now let's talk about property selection and deployment. We do not hold an inventory of homes. The project allows for the tenant to actually pick the home. They go into the market, they find a real estate agent, they go searching for homes, and they settle upon a home that meets their needs and that they like. And then they come to us and they say, I've got a home, I want to purchase it, lease to own model. And we prioritize based upon two factors. One, when you apply, so the first person to apply is first on the list. And secondly, it's based upon timeline. So if you have, for example, a person that comes in, they're first on the list, but their purchase agreement says they're going to close 6 months down the road, and somebody else comes along, they're in third place, and they are closing in 3 weeks. Well, that person is going to take priority. And then if you have, 10 people that are closing in 3 weeks, but person four applied first, well, they're going to be at the top of the list. And if you qualify for, like I said, any of the six standard automated approvals, you'll get funded, the property will get acquired. If not, then we will create a governance proposal and the community will vote. Okay, so let's talk about staking for a second. Um, in order to pass the Howey test, Ethy tokens themselves cannot have an expectation of yield. So you can't earn a yield on Ethy tokens. You can vote with them. You can participate in the overall growth of the token in value based upon trading, right? It'll trade on various crypto markets, but the token itself cannot earn an actual yield. If it does, then under the Howey test, it becomes a security. And the reason we don't want it to be a security is we want it to remain decentralized. We want the community to vote. We don't want government regulations that currently exclude people from getting into home ownership, right? The current rules promote the wealthy getting wealthier, and they get wealthy based upon people paying rent, right? We want the people that are paying rent to get into home ownership. So we need to remain decentralized. So the mechanism that works for this is very similar to playing bingo at church, right? You go into a church or you go into one of these kids, uh, 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 pizza and game places, and you trade money for tokens. And then you use these tokens to play games, right? And then at the end, you can trade those tokens in for some kind of a reward. So here, the Ethy can convert 1-to-1 for Z Ethy. Z Ethy, you can stake. Currently, we have one staking pool, and we anticipate having more. Uh, and that staking pool will generate yields. Currently, the yields are accumulated on a monthly basis, but higher yields might be possible if they were, paid out over a longer period of time, like 3 months or, yearly, or quarterly, that type of thing. Currently, there's no lockup period, but higher yields could be if there were a lockup period. And then as you earn these Z Ethy tokens, you can convert them back to Ethy if you wanted to liquidate or if you wanted to sell or participate in the governance vote, right? Or you could move them to different Z Ethy pools whenever they become available, right? And so only Z Ethy can earn rewards and only Z Ethy can be staked. The Ethy token can only participate in either a governance vote or you can buy and sell them freely in the open market. So this does a couple of things. It allows people to participate on the investor side in a long-term asset, real estate, but yet have the liquidity to be able to sell their ownership at any point that they want, right? You can be an Ethy holder. The tokens are supported by real estate. You can participate in market growth, hopefully. I mean, the market could go down too, right? But generally speaking, real estate over a long period of time will grow in value or at least hold its value. You can participate in sharing in rental income by staking as ZETI. And anytime you need to liquidate for whatever purpose, you can convert back and sell your ETH tokens at whatever the then current value is. And there's no restriction from our side. What's going on here? Why is that moving? Okay, there you go. Okay. So where does the yield come from? Well, it comes from a share of the rental proceeds, right? So when a tenant pays rent, let's say, just for simple math, we raised 100,000 in monthly rent. Okay, we actually collected 100,000 in rent. And after all the expenses, property taxes, property insurance, an administration fee, to the property manager, um, you get 100,000 in net rental. And let's say 1,000 shares are staked. Not 1,000 people, but 1,000 shares, right? One person could own 1,000 shares and stake them all. Right? So that 100,000 will be divided over 1,000 staked shares. So that's basically $100 per share. Simple math, right? Now, the interesting thing about this is that you have organizations out there that will claim, oh, we're going to pay you a 60% yield or 50% yield. Well, this is not sustainable, right? In the real world, we're lucky right now because, with the project, the two transactions we funded so far are yielding a net 5.25%. Okay. This could vary up or down as the market changes, but it is a true net rental property share of whatever is earned. And this is paid to the ZFE token holders as more ZFE. So your ZFE grows in quantity. And then the ZFE can be converted one to ETHI and sold. So currently, we have basically a fixed uh, staking pool. Its current yield is 5.25 over a 12-month period. It could adjust after 12 months because we don't know what the market's generally going to do. So we anticipate having a variety of different staking pools. For example, we may have a commercial pool where, we have a commercial tenant. The commercial tenant has a 20-year lease or a 25-year lease. We can fix that pool to a specific yield. We may have a pool that is, based on real estate, single family homes. That yield is going to vary a little bit because as the rates vary, as interest rates vary, so would the lease rates, right? Because remember, this is designed to get people into home ownership. So we're collecting rental income, but we're also collecting rental income on the finance. We're transferring all the maintenance, all the other responsibility to the tenant. So the rental payment doesn't need to be as high. So that could be variable because the rates today could be more or less than rates, 6 months from now, and that'll have a marginal effect on what that pool is going to yield. Maybe instead of 5.25, it'll go up to 375, or maybe it'll go down to 5.125. So it's gonna vary according to the market. But we'll have different staking pools. Um, for different types of things. So we'll have one right now for single family. We anticipate having one for multifamily, one for medical, one for you know maybe nonprofits and so on. So and pools can be created by governance vote also. Because remember, the community has the ability to create proposals, and then these proposals can get voted on, and then we would, act accordingly. So the main risk in our transaction, as we see it, is the rent collection, right? Um, there is, of course, some risk related to the property value going up or down, right? The real estate market. The real estate market could crash. But over the long term, if you hold the tokens long enough, right, properties will generally appreciate or maintain their value. So we have a great deal of experience in minimizing the rent collection, the risk. Again, distribution, can vary. Uh, I've already talked about future pools and whether or not they may or may not include lockups. So who owns the property? Well, our model is we create a trust. The trust owns the property. Um, Ijara CDC is a nonprofit, 501(c)(3) nonprofit. We create the trust, and the trust holds the property for the ZFE token holders. The if ethical finance stops operating, and remember, we've been in business for a long time, but we have always planned our transactions so that uh, there is protection for the investors and the tenants, right? So that uh, in the event that something were to happen to the ethical finance token, well, number one, the assets are still there. The real estate is still there. The trust is still holding that asset, okay, for the benefit of the ZFE token holder, right? So those rewards are still going to get paid out. There's a third party company, Jara Work Services, which has been around also for 21 years, that manages uh, rent payments currently on 1.7 billion in transactions right now. So we handle through Jara Work Services, we handle rent collection, the payment of the property taxes, the payment of property insurance, the distribution of profit, and the principal allocation to the tenants, right? Now, uh, I would say that the biggest risks are all handled here. Number one, the project through Ijara Work Services is paying the property taxes, which is, as I see it, one of the larger risks because if somebody doesn't pay their property taxes, well, tax liens take priority, right? And then there's property insurance. We want to make sure property insurance is paid because if there's a natural disaster, a hurricane or a tornado, tree falling on the house, we want to make sure that that property is adequately covered because that is the main benefit is only possible if we're collecting rent, right? So we want to make sure that we have a qualified tenant. And again, that's the six different categories. And then the seventh category is the governance vote, right? We do not decline anyone. Only a governance vote will decline. But we will take 21 years of experience in this industry and apply it to determining various different types of risks and which pool that they should fall into. So again, real estate market downturn, liquidity risk is obviously value of the token, right? And tenant default. But I think we've got most of those pretty well covered. Again, real estate market downturn, we can't really do a whole lot about that. Just uh, know that there's a physical asset, so there's a physical bottom to this, right? But as long as there's a tenant paying rent, the income should be there and the property should eventually gain its value back. So um, again, I'm just going to skip through this because I think I've pretty much covered some of this. But we really recommend, when people get into this, that they're in it for the long term, because the long term is where they'll see the greatest, I believe, gain in value for the token. Remember, this is not a get rich quick scheme. This is a real world asset. Real world assets don't generate 60, 70, 100% returns, not immediately, right? So we need to be cautious of that. You will get a good return. You'll participate in the ability for the real estate to grow in value, and hopefully the token will also grow in value. The main risk, as I see it, is missed rental payments. And again, risk is mitigated here because the trust holds the title. If somebody doesn't pay their rent, we can evict them and we can find another tenant, right? And or we can liquidate the property and sell it, right? The tenant is responsible for all of the maintenance. They pay their taxes, insurance, as an additional rent, right? So we know the taxes and insurance is not going to go up over the years. I mean, it's not going to stay stable over the years. It's going to go up. And as it goes up, so does their additional rent. Okay. And all the maintenance, cutting the grass, shoveling the snow, fixing, leaking faucets, changing light bulbs, uh, uh, whatever other maintenance is required is 100% the responsibility of the tenant. So you're really taking, some of the headache out of managing real estate or the unknown expense of taking care of real estate. Of course, the big catastrophes are covered by insurance. And you've got the secondary market volatility risks. Well, you know, um, they really, again, we can't really control this. This is the market. But by having Ethy traded on multiple exchanges, by not having any mandatory lockup periods, again, we may have some which will generate higher yield, but the higher the risk, the higher the reward. And you can transfer it to, various different wallets, right? Currently, to stake, you have to hold the tokens in our wallet. To vote, you have to hold it in our wallet. But anytime you want to, you can transfer to any wallet that you may own that supports the Polygon network. So again, token price fluctuations. In my view, if you hold it a period of time, those fluctuations will go in the positive direction. Having an asset-backed model, I think, is critical. Once people understand that this is backed by something physical, not just air, not just a concept, not just a computer function, it's actually backed by something you can touch and feel. You can hop on a flight or take a taxi or a boat, go visit, these properties, right? They're physically there. So some of the, other risks are, okay, mismanagement. Well, okay, here, we have an organization that's been around for 21 years that's managing 1.7 billion in transactions. So, you've got a little bit of history there. Um, the trust structure separates the ownership, right? Each property is an individual trust, so there's liability protection there. Um, the treasury funds of 49% of the assets are managed by a governance vote, right? So yes, even though there's a wallet that's holding almost 50% of, the tokens, it's controlled by a governance vote. Another risk is, the regulatory landscape. Currently, um, the project uh, is falls under a real estate brokerage governance, not a securities governance. And we really wanted to, we worked really hard to structure it so that it would remain that way. Now, remember, we have 21 years of experience in doing this. So the real estate component, and we have a real estate brokerage, it's called a Jara Realty LLC. This is an actual real estate broker. It has a brokerage license. The actual transactions, the picking of the tenants, the acquiring of the property is done by the real estate company under the regulatory compliance of a real estate brokerage. So currently the token would not be classified as a security because it falls under real estate licensing. Now, as the regulatory landscape changes, so will we, right? But for right now, we're able to operate under a the umbrella of a real estate company and not as a security. So, of course, on chain, you've got governance voting is on chain. The issuance and transfers of tokens is all on chain. Staking is on chain. Off chain is the tenant applications they apply using our automated application system. The actual management of the real estate. Credit checks. We're currently set up to do credit checks. And rent collection is in fiat, right? But it could also be in crypto, because obviously, as a crypto project, we would accept rent payments in pretty much any form, as long as the value is equivalent to what the agreed upon rent is, and as long as, of course, the rent is paid, in a timely fashion. So once again, governance right for FE tokens. FE token holders vote on proposals. Treasuries, and I can't stress this enough, the Treasury releases require a governance vote, and anyone can submit a governance proposal. Just go on the app, and create a governance proposal. This is truly a DeFi project. So we've got safeguards built in. And, basically, it's a very simple project. It's based on rent to own. The community has control. We are just facilitating uh, the the acquisition of the property, the collection of rents, and the distribution of profits. And that is my presentation. I think I did it in about 30 minutes.
Good job. Well done. Thank you so much for that. If anybody has any questions, please pop them into the chat. I have a couple questions myself. Um, so you mentioned earlier that you currently have one pool that people can stake in, and we talked about staking in part one, so everyone on the call should understand staking pools. But then you mentioned that you are looking to bring on some more pools. And I'm just wondering, what is the value of having different staking pools?
So it depends on what people's goals are, right? Everybody has a different goal. Some people may see that, well, I think the single family real estate market is a good market, but I think I'll get more growth and more stability in multifamily. So then we would separate out into multifamily. There may be some people that want to only invest in medical buildings, right? There may be some people that only want to invest in industrial buildings. There may be some people that want to, well, I want to do more social good. Yes, I'm doing a lot of social good by having, people get into home ownership, but I want to participate in funding a church, right? So then we have a pool that will do nonprofits, for example, or I want to fund, community centers, that type of thing. So having different staking pools will do a couple of different things. One, it allows people to decide, what their risk tolerance is, if they believe that one type of property has more or less risk than the other. Two, depending upon what that pool is, maybe a long-term pool, so maybe the rate of return is higher. So you may say, okay, well, I like this pool because I'm getting a 6.5% return, but I gotta tie up my money for a year. That's fine. I'm happy with 6.5% over 12 months. Or you may be, no, I need to keep my money liquid. I may need it in a month because for whatever might be happening, right? So you want to keep your money more liquid, so you keep it in a pool. But if your money is more liquid, well, obviously the return is going to be less, right? Just like if you were putting your money into a savings account at the bank, I mean, they pay practically nothing, 0.02% or something like that, right? But you have access to your money right away. So if you want a higher yield, you may have to type your money for longer into a staking pool that gives you a better return with the type of property profile that you believe you want to invest in. And so, that's two of the big benefits of having, different types of staking pools.
Makes sense. And you mentioned the governance. So you mentioned that you buy Ethy tokens, and that gives you the right to vote, in the governance models. But in order for us to stake, we have to convert the Ethy tokens into Z Ethy. Now, so does that mean that I would, if I would have to, let's say I bought, just for simple math, I bought 100 Ethy tokens, that I would have to keep one token available so that I could participate, in the voting? Is it one token per vote? Just so that, oh, I think, is my internet? Oh, sorry, I thought my internet cut out for a second. So that and then I would say keep some tokens for voting, and then I would convert the rest to Z Eth so that I could stake those.
Yeah, that's precisely correct. You would have to actually, um, and not to get too technical here, but when you go to do a governance vote, you actually have to convert that to a GETHI, a governance ETHI token, so you can vote. So you could have 100 ETHI tokens. You could say, okay, I want to put 10 into the governance, the GETHI, and I want to stake 50 of them. Um, and then I'm going to keep 40 in case I want to sell them, right away, right? So you could do all three. Or if you're in a staking pool that has no lockup period, you could put 100 of them into ZFT, earn rewards. Some project comes up that you want to vote on, you simply convert back to FE, um, go to the governance and vote. And after you vote, you can convert them back, right? So you've got the flexibility to decide. You decide what you want to do, but it's one token, one vote.
Okay, very good. And my last question, and if anybody else has any questions that popped up, please feel free to put them in the chat. You mentioned that the whole model of, converting from the Ethy token to the Z Ethy token to avoid the whole Howey test. How is the Z Ethy token, that is where you can stake and earn rewards, not considered security?
That's a great question. And we have a legal opinion, a formal written legal opinion on this. The the ZFE tokens are not purchased. Okay, they're converted from existing tokens. And the example that I gave of playing bingo at church or something similar to that. Here we have something called a place called Chuck E. Cheese, where you go in, you can buy tokens, go in and play a bunch of games, and then you earn more tokens, right? Kids have pizza parties and things like that. Then you can take those tokens and you can trade them in for certain prizes. Okay, that's not that doesn't fall under a security, even though the function itself kind of acts like security, but it's not, right? Playing bingo is not considered gambling because you're actually not gambling with money, right? You're playing with tokens. And it's, so there's, and again, some people say, well, that's kind of like going to a casino and, you trade your money for token, for chips, and those are really tokens. But the regulations are a little bit different there. So here, when you make that transfer to zEthi, you're not actually buying a zEthi token. There's no intrinsic value to that zEthi. The zEthi is not traded on any platform, right? It can only be acquired by converting an existing token.
Makes sense. All right, we do have one question from Dee. She goes, how many rent-to-own properties have ethical finance have so far, and what's your target for expanding to help more participants in achieving full ownership?
We've only funded two transactions so far. We really need to, raise more capital. We need more people participating, right? And our goal, I mean, look, we've got over currently in the fiat market, if you will, we funded over 4,000 transactions, 1.7 billion, right? Our goal is to grow as much as the market allows us to grow. I see
Makes
no shortage of people that are tenants that are paying rent, right? That can all enter into a path of home ownership.
So it's just a matter of educating more people on this model for them to provide liquidity to be able to raise the capital to be able to purchase more homes or be able to offer the loans for people to be able to um, be
Yeah,
a participant of the program.
right, right. And technically, it's not a lending project, right?
Mm,
I just want to make that clear. We're not actually lending money, right? We're renting property.
mm. Yeah, so
It's
that's
a
where
critical distinction.
it reduces the risk because as you mentioned, you essentially take the liquidity from the token holders that provide the liquidity to purchase the home, which goes into the trust. And then the yield comes from obviously the yield of the property, but then also from the rent.
Yeah, from the rent. The
Mm,
yield comes from the rent.
perfect.
And if the tenant stops paying rent, guess what? We have the property still, right?
Hmm.
We may miss out on a couple of months worth of rent payment, but we still have the basic asset, right? It's like you're able to participate in rental home ownership with that security, right? But at the same time, you're performing a social good. You're helping somebody get into home ownership and build generational wealth, right? Get out of the cycle of poverty. And this is something that I think you can earn a reward, you can participate in potential growth of the token, and your heart can feel good because you're doing a social good at the same time.
Yeah, definitely. That's why I think your project and our ethos very much aligned. So one last question I have, and I'm mindful of time. This has turned into a long one, but very educational. So let's say hypothetically, the tenant misses rent payments and you evict them, and then the vote is to say sell the property rather than say finding another tenant to take over. And say there's a capital gain of say like $100,000. Is that capital gain from the property divided amongst the token holders of that pool?
That's an excellent question. And the answer to that is that that capital gain is actually taken against, well, they're not distributed individually directly to the token holders, but it's distributed amongst the other properties in that project because there will be taxes that will have to be paid, and
Mm-hmm.
it'll come from the taxes that would have to be paid on that capital gain would be paid by the rental pool, right? So if you got 100,000 in rents coming in, and your tax liability is $5,000, you'd pay that $5,000, and then the 95,000 is what would get distributed. But the gain itself is in fiat, and that would be reinvested in potentially another property, right? And so then that pool asset base would grow.
Makes sense. Making the overall sustainability of the project stronger.
Right.
Well, thank you so much. Thank you very much, everybody that joined. I hope that you all learned something. I definitely learned more. And the next webinar next month, we're going to dive in and talk a little bit more about the lease to own model for those that are thinking that you might be the type of person that would want to apply for this type of program. Now, I know it's only currently available in the US at the moment, but as mentioned earlier, they're looking to expand to other markets. So I think that it's important to understand the lease to own model and the benefits. So, Shweb, thank you so much again for your time. Thank you for getting up so early. I know it's an early morning for you. Thank you for everybody that joined the call. And we hope that you learned something new. And once again, we'll share the recording in the Education Hub. So if you know anybody that would be interested in this or get value from understanding the ethical finance token model, please make sure that you share it with them and send them to the Education Hub so that they can watch the recording. Thanks again, everyone. Have a good night.